Hey everyone, welcome to Ask the Loan Officer episode number 6, I believe. Last week we had Evan Johnson covering for me while I was down in the Keys. Today we have Joel Bailey with CRM Lending. How are you, Joel?
I'm doing pretty well, Mark. How you doing?
I haven't seen you in a while.
Has been a while.
Thanks for joining us today.
Hey,
We
thanks for
have
having me.
we have a bunch of stuff to cover, but a little bit about you, Joel. You're from the area, right?
Well, I went to the University of Maryland, so I lived in College Park for a couple years, but I'm from the Eastern Shore of Maryland. So born and raised near Salisbury, grew up around Ocean City, and been around DC ever since college. So
Oh
been here for a
well,
while.
so you know the town.
I know it a little bit, yeah. And I live out in Edgewood, out in Northeast. So
Okay.
yeah.
All right, let's see. Rates. That's where we're going to start today because everyone wants to know about rates and where we are. A couple different programs I'd like to know about, from 30-year fix to maybe some ARMs you can tell us a little bit about. So why don't you go ahead and take that away to start with?
Yeah, so of course, the first question everyone always asks is, what's your rate? What's your rate? And it's not a very straightforward question. There's a ton of variables involved, but to give you the vanilla loan product of what the best rate would be for a 30-year fix today, you're looking right around 4.5%. And that's excellent credit, low ratios, everything like that. And that's 30-year fixed rate. If you want to take a little bit of risk, you can drop down to a 5-year or 7-year ARM. And if you drop down to the 5/1 ARM, you actually can drop that rate by 0.5% down to 4%. And the rate's locked for 5 years, and then every year after that, it adjusts. And with the way rates are going, it's probably going to adjust upwards, but there are caps. So if the market goes crazy, you're limited to how much risk you're exposed to.
Okay, so an ARM is an adjustable rate mortgage.
Correct.
For those that don't know what that is. And the caps usually, tell me if I'm wrong, if you go with a 5-year ARM, then after the 5 years, they usually can't go up more than 2 points per year to a max,
Yeah.
to a
That's
maximum
usually,
of 10.
yeah, that's usually the cap. There's a cap on how much they can adjust each year and how much they can adjust total, depending on which product you use. But
Okay, so if
yeah,
someone was buying property, like say someone's buying a condo today, they're going to get a 1-bedroom condo. It's their first place, and they know that they're going to sell it in 5 years. Then a 5-year ARM is probably the way to go for them, right?
yeah, 5-year ARM, you would save a large chunk of interest in that 5 years. And even let's say it took you an extra year to sell it, when that rate adjusts, you're still going to be in the green with the interest that you saved. But it's not for everybody, because some people might want to rent that condo out. So you're looking at a refinance after 5 years or 7 years. But if you're really trying to get the lowest rate, you might have to expose yourself to a little bit of risk. But it is locked in for 5 or 7 years.
And you say that's somewhere around 4%, depending on the cost, the
Yeah,
price of the property.
let's just say a single family home, 4% flat, maybe a condo, 4 1/8, 4 1/4. Condos always have a little bit of a price hit.
You mentioned the rate is going to depend on ratios. You want to explain what that means to people that might not understand that?
Yeah, so the magic formula that lenders use is the debt to income ratio. How much your income is compared to your monthly debts, your student loans, car payments, credit card payments, etc. And basically, lenders or loan insurers like Fannie and Freddie, the higher your ratio is, the more you're spending of your income, the riskier the loan file is. So if we can go up to, let's say, about 50% of your income can be used towards all your monthly payments. That's the new mortgage, car payment, etc. Someone who's maybe down at 33 or 40% is going to have a lot more income left over, so it's a less risky loan, and you're going to have a more favorable interest rate.
Good to know. Also, when you're calculating your ratios, I would not count what my rent payment is right now, but I would count what my lease payment is on my car.
That's correct. Yeah, because you're going to move out of your apartment, so we don't care about the rent because that's going away.
Got it. All right. Let's talk about getting pre-qualified. We're basically in spring market because it's super busy out there, and I've seen a lot of multiple offer situations so far. Let's talk about, what do you need from people to go ahead and get a pre-approval?
Yeah, it's
How do they prepare?
it's really not as difficult as everyone thinks. It can be done in a couple of hours if you have everything available on your laptop or online or whatever. But we have to look at your income. So pay stubs, we want to see some assets for the cash to close. So your bank statements, 401k, investments, etc. Going to need the personal information like your driver's license, social security, addresses, so we can run the credit report. And that's pretty much it for a preliminary pre-approval. I would say once we look at the income, the credit report, and the assets, you pretty much know what you can afford. Now, that being said, if you're really looking for a streamlined loan process, you want to get that short contract, everyone wants to close in 15 days, 20 days, then, you can be much more thorough and request documents that the underwriter's going to need to see. So it really depends on the client. Some people just want to get that quick pre-approval, but if you're looking for that streamlined process, then we can dive in and just get all the docs up front.
If I am a self-employed individual, or I get 1099s, what is the underwriter looking for? I know that it used to be the last 2 years of taxes, and then you average the two together. Is that still the case on most of your products?
In a nutshell, yes, but and I should have mentioned that earlier. We want to see the tax returns too, but if you're W-2, we don't always need to see them. But 1099, self-employed, got to have your tax returns turned in. And so we're looking at your net income. So you write things off. It costs money to make money. That's obviously not income. So and there's certain things we can add back, like car depreciation, business use at home, things that aren't out-of-pocket expenses like that can actually be added back.
I didn't know that.
Yeah, it's usually, I would say 9 times out of 10, it's not there, but it's always good just to scrub through, the Schedule E, and there's some things that we can add back. But yeah, and then we take, the last 2 years. So I'm doing one right now where business owner hasn't filed yet. So me, the client, and the accountant are actually all kind of consulting to see how much she should write off to make sure that she qualifies for a home. So
yeah, I had that's what my accountant told me. I was like, I need a bigger approval, and like I'm writing all my business expenses. He was like, don't write them off, pay the government more. It's like that sounds to me like, why am I paying more in order for me to get my mortgage?
It's a double-edged sword, man. The government knows everything, so
out are the days of stated income. But now we're talking about a little bit of taxes. So I get a lot of people that, neither one of us are accountants. So let's put that out there. We are not licensed accountants or CPAs. But in the end, when you're looking at what you're paying for your mortgage, it ends up being less than what you're actually paying at the end of the year in more cases than not. Isn't that what you're seeing? Like a 500, like maybe a $1,500 mortgage payment ends up really costing in the end $1,100.
Yeah, you're talking about like interest, tax deductions, that sort of thing. Yeah, sure. You can write off a good chunk of your mortgage interest, and like Mark said, we're not tax specialists, so I don't want to give tax advice, but you do have long-term benefits of homeownership. And in addition to that, if you're investing in your house, a certain amount of the, say you just bought a house, and you took money out of your 401k, that's tax qualified. Or if you sold your house, and I'll keep this very light, but a good chunk of when you sell a home, the equity is actually tax-free. It's a certain amount, and you have to, be tax qualified. But not everyone knows when you sell your house. I think it's the first $300,000 of equity are tax-free. That may have changed. This was last time you really saw that was 3 years ago.
Oh yeah. We're not gonna put you on the spot for specifics on that. Well, that's good to know. We always say talk to your tax specialist to find out where you are. For me, in my personal situation, when the last time that I had my mortgage, my accountant actually told me increase your exemptions if you don't want to get a whole bunch of money back at the end of the year. So I listened to his advice, and at the end of the year, I washed even. But every situation is going to be different. You have an interesting product that a lot of people don't know about, and I don't have a whole lot of lenders that do it. It's called the 203K loan, which is essentially a renovation loan. You want to talk a little bit about how that works?
Yeah, so it's an FHA loan. So it's going to be a government loan. The minimum down payment, no matter what's 3.5%. And that is capped at a certain purchase price. But in a nutshell, it's basically just a renovation loan, like you said. And there's two different types of it. You have the standard and the limited. The limited is going to give you about $30,000 of renovations. So let's say you were looking at a nice row home, but the kitchen was a little out of date, or the cabinets aren't your style, or the bathroom is just not really doing it for you. You can do the 203K product and get a contractor in there and just renovate the bathroom or do a new kitchen, whatever you want to do. And that's the limited. And the caveat to these programs are they do take a little bit longer to close. So the limited, we usually say about 45 days to close. But the standard, there's no cap on the amount of renovations you can do. The only cap you have is the FHA loan limit. So you're talking $680,000 roughly in loan, and you can renovate a row home or a qualified condo to whatever you want. I mean, I'm doing one in Northeast DC. We were talking about this earlier, and it was a bit of an out-of-date row home. The structure was fine, everything was fine. It's just kind of out of date, and the buyer just went in there and gutted the whole thing, brand new kitchen, floors, knocked out some walls, combined the bedrooms to make one big bedroom. Like it's just amazing. She really, with 3.5% out of pocket, was able to just make this row house her own little thing. It was awesome.
So with that, I mean, it's a great product. I actually haven't dealt with this product in a few years. I remember, so first, if someone finds a property, typically lenders are want to make sure that the whole property works and all the appliances work and that it's a livable property. The 203K plan still the same on that? It's like if, fine, you want to renovate a kitchen, what if the kitchen doesn't work? Like what if the appliances are missing? Is that an issue getting in there?
You can wrap that in. You can wrap that in as part of the renovation. New plumbing, you got to fix the roof, whatever you got to do. That it's a renovation / rehab loan, so it's also rehabilitating as well. So anything that needs updating or bringing back to life, you can finance it.
So on that loan, if I remember correctly, you have to work with an approved contractor, or is it just a licensed contractor for the city?
If you're doing the limited program, so the $30,000 or less, you can use any contractor. You want to do the full program, it has to be a 203K consultant is what they're called.
That's what I'm remembering.
Yeah, so and they're pretty abundant in the area, and there's a lot of really great 203K consultants, and they're just there to make sure everything goes well, and it's an awesome program, but when you get down to the details, it can get very complicated. So it's important to have people that know what they're doing.
Sure.
Because it's not like closing a regular mortgage. A little extra paperwork, a lot more kind of just sitting on your hands. And that full program, we can close it in 45, but we usually say 60 just because you never know what's going to happen.
Mm-hmm. Yeah, I remember the lender was asking me what the value of the property was going to be after renovation. So I had to turn in a bunch of comps for that. Is that
Mhm.
still the case? Because you want to
Yeah,
make sure that you're not upside down after you put in all of this money and you guys,
yeah,
right?
yeah. And usually the agent can just pull the comps and be like, no, we need to stay in this range. But the cool thing is with single family homes, they give you about a 15% buffer. So if it doesn't appraise, you can still finance a little above it. So I think it's like 115% of the appraised value you can finance. So if you miss a little bit, it's not that big of a deal.
All right. Good program. Good to know.
It's fun. I mean, on my end, it can be a nightmare sometimes, but it's a great product for the client.
What about uh, what about bridge loans? You do anything with those?
You mean like a
Like
HELOC?
say,
If you
say I need to buy need to buy another property right now, but I have
Gotcha.
to sell my other property, so I don't have the money from that yet.
Yeah.
Do you have any holdover loans like that?
Yeah. So the way that we do it is we don't actually do the bridge loan, but what we do is we connect with a credit union who opens an interest-only HELOC on the house. So it's a
Okay.
HELOC, a home equity line of credit. Basically, you open it up and you max it out immediately, and you have interest-only payments. But usually, people open those, like you said, in anticipation of paying it off.
Okay.
So yeah, you want to sell your house, but and you can qualify without selling the house. And yeah, it's a pretty simple product. It's just a HELOC, but we close it externally, and I think most lenders do. I'm not sure of any that maybe banks like Wells Fargo might keep it all in house, but most of the time you broker it out. Just I think there's a couple guidelines where you have to send it somewhere else.
I like it. I like it. If you have any questions for Joel today, then feel free to ask away on here, and I'll throw it up on the screen for him to answer. There's a little bit of delay in our broadcast, so give people a second for that, and then we'll wrap things up. What else, Joel? What else we have to talk about today?
I don't know, man. I was looking at that thing you put on Facebook, and it's kind of frozen where my eyes are closed and mouth is open. Is there a way to
I,
change that?
I'm showing you still moving, but
Maybe the delay is just happening. I don't know. But
maybe the delay is happening. I can switch over. Let me see what we have going on here.
I'm just kidding. No, but I don't know, man. Like you said earlier, it's starting to happen before you know it. I mean, it's March. We if you want to buy this year, there's no reason to wait. Get yourself pre-approved. Start looking at some properties because in DC, as soon as that inventory gets dumped out, contracts will start getting written right away.
Absolutely. Yeah, you were saying earlier that you were talking to some developers that had a bunch of inventory getting ready to come on.
Yeah, I know one developer I work closely with. He's dropping 9 at the end of the month, 9 properties.
Oh,
He
wow.
does he does the row home flip to condo conversion.
Okay.
Yeah, he's got a couple in Bloomingdale, a couple out in Capitol Hill. But and I was talking to another developer, and it's like the same thing. In April, they're dropping 5 or 6. So it's
Good.
happening.
So inventory is coming. So I like that.
Yeah.
All right. Let's see what we have here. Hello, Cheryl, also known as Ma. What ratios will they let you go to on the limited program? I think
What's
that's
up,
what
Cheryl? That's a good question. 2 or 3K is a little bit riskier loans, so we try to keep that back ratio around 47, which is still a pretty good ratio considering Fannie lets you go to about 50. But 47 is the magic number on the back end. And there's some wiggle room depending on if you have some reserves or other factors. But yeah, right around 47.
What's the back ratio?
Back ratio is all your debts. So your mortgage plus your car payment, your credit cards, etc. The front ratio is just the mortgage. And we like
Great.
to keep that front ratio right around 33.
All right. Before we cut out, let's real quick talk about the worst thing you can do right before you close on a property. What has crashed the loan at the last minute for you? Sorry to put you on the spot, but I'm sure that you have lots of stories up there in that head of yours.
Yeah. Moving money around. Everyone likes to keep their cash in a certain account. keep it where it is. If you showed bank statements with it on your checking account, don't put it in your savings to get $2 on interest for 10 days, because the underwriter will have a problem with that. So don't move money around. New accounts, that's a big thing. You know, you bought a mattress, you bought a bunch of furniture, and we refreshed the credit before 10 days before closing. We refreshed the credit, and new accounts, you got new payments, the ratios change. If you're maxing out your ratios, you might not be qualified anymore. Same goes for existing accounts. If you have a credit card, and another common thing is you buy a bunch of stuff for your house and you max out the credit card, you went from having a $25 payment to a $150 or $200. That could put your ratios over and disqualify. So I always tell my clients, before you do anything financially, just call me. I'll let you know. Even if you don't think it matters.
Don't close old credit cards and all of that.
No.
Just wait. Wait until you talk to someone. Sarah Williams has a question. Once you qualify for a rate, how long is that rate good for?
Okay, let's say, all right, qualify for a rate is a little bit ambiguous, but let's say you're talking about locking for a rate. So you're qualified and your loan officer says, let's lock your rate. The standard is 30 days. You can lock it for 30 days or 45. So 30 days, and if you run into some issues, you can always get an extension on that. It usually costs a quarter of a point. So for a small price, you can extend that rate.
Good to know. Yeah, Sarah, if you are qualified for a rate on that day, then that rate is good on that day. If that's what you're talking about, if you're locking in, it's a different story, right?
Yeah, or for that hour. I mean, you know.
Or for that hour. Yeah.
Our friends in the White House start talking to somebody, and then rates go somewhere else. It's very volatile.
Yeah, they're all our friends. All right, Joel. Well, it was nice talking to you today. Thanks for coming on. Haven't seen you in a while. Let's catch up.
I'll see you around, Mark. Let's do that.
All right, we're talking to Joel Bailey from CRM Lending, and his information is here in the comments. I'm Mark Rutstein with dcrealestate.com, the Evan and Mark team of Compass. Reach out if you have any questions, and we'll send you a direct message back. Thanks, Joel. Have a good day.
Thank you,
Happy
Mark.
Friday, everyone.
Happy Friday. You guys enjoy your weekend.